put the links in the chat, Stefania, if you want to refer to them. So.
Okay, I also have the web page open, so I'm just gonna.
Yeah. Okay, well, welcome everyone to this next edition of VMACS. Just a reminder of the ground rules. Everyone's video will be muted at all times. We cannot turn it on, nor can you. Everyone's audio will also be muted during the Q&A session at the end. In the final 30 minutes, we will give you the opportunity to unmute yourself and ask a question if you raise your hand. So without further ado, let me introduce today's host, Stefania Albanese. Stefania, take it away.
Okay, thanks, Kurt. So before we get to today's talk, we'd like to make an announcement. As many of you know, we put out a call for organizers for a VMACS Junior Conference, and the organizers have now come up with a format for the conference and dates. So we'd like to announce that. So the Junior Virtual Macro Conference will take place from Monday, August 31st to Wednesday, September 2nd. And it's going to feature several parallel sessions. And if you're a junior macro person with a broadly a macro paper, you are more than welcome to submit to the conference. The deadline for submission is July 24th. And you can find all the details about the conference and how to submit and so on our webpage as usual. So if you are a junior macro person, please consider submitting and go to our webpage and get the details. And instead, turning to today's talk, we have Claudia Sahm presenting work with Matt Shapiro and Joel Slemrod. And Matt is here with us answering questions on basically stimulus payments to households and individuals during the COVID-19 crisis. So Claudia, go ahead. Thanks.
Great. Thank you, Stefania. All right, so I'm going to go ahead and share the slides, hopefully. Maybe. All right, there we go. Okay, so as Stefania said, I'm going to be presenting research, very preliminary research with Matthew and Joel on how households are responding to the 2020 recovery rebates. I'm also going to talk a little more broadly about what we know about sending direct payments to people and set something in the current policy discussion about the relief that Congress is sending out in the COVID-19 crisis. Okay, so yes, so I'm going to do both of these things today. And I will say, for those of you who've been joining the seminar series, I certainly have appreciated the modeling work. We have a lot of structural papers, a lot of really interesting work thinking about this current crisis and the tools that we as economists, and particularly macroeconomists, have to add to the discussion. The paper, the research broadly that I'm going to discuss today has a much more empirical grounding in it. I mean, all of you know that do modeling, you want to have assumptions that tie back to reality. You can't tie everything back to reality, but I think these are really timely estimates and are a good discussion for those of you who are ever interested in taking your research and helping shape policies that come out of Washington, D.C. Okay, all right, so in terms of thinking about the direct payments to people in recession, and these are often referred to as rebates, there's really a lot of prior research that shows that these one-time payments are an effective way to support families in a recession. The money is spent quickly, it is often administered very quickly. We certainly saw this time. And so if you think about ways that you broadly support households, this is separate from jobless benefits, things that go in a more directed way, this seems to be really the way to do it. A silver lining of the Great Recession is that many different policies were tried to support households. These are ones that Matthew and Joel and I studied among many other researchers. And so we come down to the place where it says, well, these one-time payments seem to be the way to do it in a recession. Okay, so that's, and I'll talk a little bit more grounding it in the prior research. The research that we're working on currently is focused on the 2020 rebates. We're applying methods that we've used in the past to, and I mean, Matthew and Joel have used them in 2001, a prior, I think it was 1992 with a withholding change together we've looked at the 2008 tax rebates. We also used a similar methodology to look at the 2009-2010 Making Work Pay tax credit and the 2011-2012 payroll tax cut. So again, this methodology, we're being consistent largely across time, and I think that will help us think about what's happening right now with these rebates. Okay, and then like I said, I'm gonna spend some time at the very end talking about how we can think about these direct payments in a policy setting and talk some about making them automatic. So having these be a part of an automatic stabilizer approach to fighting recessions. All right, so there's just very briefly, there's been, and you can see, and this is not exhaustive, I was trying to show that in the different ways that we understand how households use these rebates or these direct payments, there's a large number of researchers who have contributed to this literature. And I think very importantly, there are, there's many different empirical approaches to different data sets. And to me, that's really a sign of it being robust findings. And that was certainly something when I worked at the Federal Reserve, and one of my focuses in being a lead economist on consumer spending is I had to, from the very beginning in 2008, think hard about, well, how do households respond? How does consumer spending respond? And it's very important in policy settings, not just to march in with my research, but to explain how it fit in with the many different studies that were happening at the same time and had been done like in 2001. We learned something then too. Anyway, so the keys are, we see that these are a large fraction is spent and rapidly. I mean, there's some differences about exactly how much is spent. And yet they are very different from a very baseline consumption smoothing economics model where we say, as this one time, it's temporary, you like calculate the annuity value, you spread it out for forever. That is absolutely not effective in a recession to help support demand. You need it to happen fast and you need it to be a big response. It looks like, from what we know, and there's some really good identification strategies that Parker, Sleilis, and co-authors have used that, I mean, I think ought to be convincing economists this is useful. And like I said, we've studied, Matthew and Joel and I studied a number of the different policies that were used to support families in the Great Recession. And by far, these direct payments are the best, and they make a lot more sense in terms of getting on the front end of a recession and trying to like stem the damage. And one of the findings that comes out of the research, and I'll come back to this, is that when we try and understand, well, who is it that spends these rebates? And this is important for a lot of these distributional macro models as well. Like, what is it about like the spending responses we see that ties to households? It's pretty clear from research in the rebate space, but also more broadly about temporary boost to income, that often, not all studies find this, but often what we see is that families that have less money that's easily accessible, so like low liquidity, they tend to spend more and more rapidly. And we think about that, these are like pretty standard consumption models now. It's just, well, they already wanted to be spending more before and they just didn't have the money. You give them the money, they go out and spend. I'll come back to that when we think about how to design rebates, but that is a pretty clear like thing that we see, a behavioral response. But again, there are exceptions to this, and some papers show it more strongly than others. I will like just pause to note what is much less robust is that low income households are more likely to spend more. So it's really about liquidity. Low liquidity is correlated with low income, but there are people up through the middle class, the wealthy hand-to-mouth research, that they're higher income, but they have very little in liquid assets, and they will also spend. So research is good. We've learned a lot about this type of stimulus support. Okay, so the 2020 recovery rebates, just to give a few details on it. So Congress enacted these rebates as part of the $2.2 trillion Coronavirus Aid Relief and Economic Security Act, so the CARES Act. This was enacted, signed by the president in late March. The rebates are a payment of $1,200 per adult and $500 per dependent child. The eligibility of these rebates is basically anyone that has a Social Security number. And there is a phase out, like your income can't be too high, but basically a really high fraction of people in the United States have a claim and actually have received these benefits. And so because these are big dollar, right, these are large amounts going to families, they are really widely, the eligibility is very wide. So what this ends up is the rebates in total are a lot of money. So it was about $300 billion. And this money is out the door. There were some people it took longer to get to, but most of this 300 billion is out. And that makes it stand out among the CARES Act overall, because some of that money still is not out the door, though it is pledged to be held. So that's good. So the research question that we're working on in this project is, well, did the families use the rebates in 2020 as in the past? So can we apply the lessons from prior research from recessions to think about what's happening right now? Okay, so to answer this question, it's important to think about, well, what's different about the rebates this time and what's different about the economy this time? And there's lots of differences, as you could guess. Okay, so first of all, the dollar amounts of the rebates are large. This is important both if you think about what it means for families, and it's also important what it does for the economy as a whole. So what this shows you are the 2001, the 2008, and the 2020 rebates. I put these in current dollars, but I mean, inflation has not been a big problem, right? So what you can see is the 2020 rebates are really big relative to the past. This is important relative to the research as well. One of the reasons why the one-time payments look like they are more effective is it does appear that households, they can do more with it. So there's Parker, Salelas, Johnson, and McClellan showed that a non-trivial portion of the rebates went to purchase new cars or large durables. And essentially, like in 2008, like that's not enough money to buy a car, right? So they're using it as down payments, which means you can get a marginal propensity to consume out of a rebate that's more than the rebate itself. So that's kind of nifty. We wouldn't have necessarily expected that. The other thing that happened this time was there was a much faster delivery. The individuals, in my opinion, who worked at the Internal Revenue Service and Social Security Administration to get these payments out all deserve like a Medal of Freedom, because these things went out amazingly fast. And like I said, a wider eligibility. So all good. But there are people who didn't get them and would have benefited. Okay, so like how is the COVID-19 recession different from past recessions? Okay, so putting it in the context of the rebates, I don't have to go through this, a public health crisis led to a recession. We have had much faster job losses. And then there's just this massive amount of uncertainty, which, as you've noticed, the stock market keeps like getting really fussy about, which it should. It's a very forward-looking thing. And right now, one of the big problems is we have really a very poor sense of like, how long does this last? When does it recover? And there's everything from real gloom and doom, like I do, to we'll be back on track by the fourth quarter, and President Trump tells us next year will be the best year we've ever had in the United States. I hope he's right, but I don't think so. Anyway, so what I want to show you in this chart, so this is the unemployment rate, and I'm sure you've all seen like the unemployment rate is just massively higher than we have seen anytime since the Great Recession, even after the recent May data that came in better than expected, and that's good. We're still well above anything that we've seen since the Great Depression. Anyway, but the other thing that is interesting about our rebates are the point in time, the point in the economic conditions which the rebates come out, right? So you can see that, I think focusing in particular on 2008, which I'm going to dig more into those comparisons, when the rebates came out, the unemployment rate was just a little bit above 5%. So that's a very different setting of the rebates that have come out in 2020, the unemployment rate was well above 10%, right? So we can think about what these rebates meant could very well differ because the economic conditions were so different in the two times. Okay, so the other thing, and this fits in with the unemployment rate, in the survey, and I'll talk a little bit more about what the survey is, we did also collect information about economic conditions in addition to how did you use the rebate. And there are other data sources that can show this, but this is new data, so I want to share this. This is from May. And what we see, and we asked about, has your family lost income because of the crisis? Has someone in your family lost a job? And if they have lost a job, are you getting weekly unemployment insurance benefits? So what we can see is just across the board, there is a massive amount of distress that families are under because of this crisis. We see, 2 in 5 families have less income, 1 in 5 lost jobs. That's actually really close to what we see as the official unemployment rate, so that's a good grounding of our statistics. And this one was surprising to us and to the policy analysts that I've shared this with. Of those people who lost their jobs, so this is conditioning on having a job loss in the family, 60% of them in our May survey had not received weekly benefits. Now, this is important because part of the CARES Act had enhancements to the jobless benefits, and importantly for this particular calculation, they expanded the coverage. So it would pick up workers who normally would not have an eligibility for jobless benefits, but as there were many press reports, the unemployment insurance systems really, in many cases, just broke down and have struggled for weeks to process the millions and millions of people that are suddenly flooding in to claim benefits. So there's a lot of discussion, and many of you have contributed to this discussion about, well, these extra benefits that also in the CARES Act, they bumped the weekly benefits up by $600 a week, and there's a lot of concern from economists, and rightly so, that this creates a disincentive to work. I do want to stress that it took time and people are still waiting on benefits, and thus, if you haven't gotten the money, it's not a disincentive. These, the $600 a month, as well as the expanded eligibility, are set to expire on July 31st unless Congress expands them. And so I think there's just one where it's important to get the, understand how policy is actually being enacted as opposed to just, well, what does the legislation say? Like, the administrative systems are really important too. And this is one where it's getting better, but the unemployment insurance system has really struggled. Okay. Now, I will say, so our survey is for May as a whole, but we can look at when people were taking the survey. And it is the case that this, like 60% of people not having their jobless benefits who are eligible for them and should have them because they've lost their jobs. If we look at the respondents before May 15th, 2/3 of them are telling us they're still waiting on their benefits. Now, if we look at the respondents after the 15th, and the survey there's more people to answer early than late. In that case, only 1/3 of the jobless are still waiting on their benefits, right? So it's improving, and our survey will run in June, and we fully expect, we'll get closer. I mean, I doubt we'll get to perfect that everybody has benefits. For those of you who studied the unemployment insurance system, there's a lot of people that are eligible for benefits and do not claim them, either because they feel some degree of shame or don't want to get those benefits. Maybe they don't need them, they can bridge. And then there are states that make it hard to claim benefits. So we wouldn't expect a perfect take up, but I do hope it improves. And it did improve over May. Okay, so but one thing I wanted to show, and this is again about this $600 per week, is what I'm showing you here is the percent of families who told us that they had lost income, that their family income had declined specifically because of the crisis. This is what I'm showing you in the chart is just people who have families who have had someone lose their job, and separating by, okay, among these families who have lost a paycheck, let's look at who've gotten their jobless benefits and who haven't, and how does that affect like their family income situation. And so you can see, and this is not surprising, if you have lost a paycheck and you are not getting your jobless benefits, your family is much more likely, I mean, there's a really high fraction that have lost income. Remember, for the population as a whole, it was 40% of families with a decline. And here we've got like 2/3 of families, lost a job, haven't gotten the weekly benefits. The thing I did want to point out and make sure that you all saw is that even those families who have had lost a paycheck and have the benefits, 30% of them are saying we have lost family income. Now, there's a lot of discussion about these $600 a week extra for low wage, and actually it's not just the lowest of low wage workers, it ends up that the replacement rate, so your weekly jobless benefits are for these workers are higher than their weekly pay when they were employed. Now this is a big part of this work disincentive discussion. Like, why would you go back to work if like you're paid more to be unemployed? I mean, frankly, I think people really want to work, but there is an issue. I mean, money matters, right? But even with these jobless benefits, which are generous relative to the employment they had, you still see families, and a non-trivial fraction of families, who've lost income. What is important, I think, in these discussions, and you all that do this can do more modeling on this, is that you, especially in low wage worker situations, they often have multiple jobs to make ends meet. So an example that's come up is gig work. Now that could be on a technology platform, or it could be just informal work sector. A lot of those jobs, which are service jobs, really shut down in the pandemic. And frankly, many of them will take a while. Like, not everybody's going to jump back in their Ubers and Lyfts. And so that was a source of income for a lot of these lower income families. They either can't or have a lot of difficulty claiming jobless benefits for them. So it's not surprising, like the jobless benefits they get make up for their main employment, but they're not going to be able to make up for all the different ways they were making ends meet. So, okay. So, and actually a broader point here is the fragilities and the financial insecurity that we had going into the recession, even though we were over 10 years into an expansion, 3.5% unemployment, like all of that was with us before the crisis. And, we do pay for that in an economic distress sense now. Okay, so just briefly, I wanted to show that while we have this widespread distress, I've talked about the jobless, the differences that families are facing are not all the same, right? So this is just making the point that you have some important differences by race and ethnicity on these three different kinds of economic distress. You can see that Hispanic families are much, much more likely to have lost income during this crisis. If you look at job losses, again, and not surprising, this is going to correlate with the income losses, you again have a very large fraction, like half of Hispanic families have lost a job in this, according to this survey. Black families are more likely to have lost jobs. And a lot of this, and this is like really preliminary work, but there's a lot of discussion about which sectors of the economy have been hit hard, and service sector is one. So if you think about the racial ethnic composition of employees before this crisis, and who is able to work remotely, who is working in essential sectors, like these are important. Like there's a lot of dimensions where these differ, and race is certainly one of them. But this one is like the by race with no benefit. There is Black and Hispanic families are somewhat more likely to have not gotten their benefits yet. But all of these numbers, as I talked about before, are really problematic because there are very few families that can go without a paycheck. I mean, up through like middle class, like it's a real big disruption. Even losing hours can be a problem. Okay, so I had a lot about the recession. I think that's, it's just really to give you data. And there are a few things I think are surprising with jobless benefits, but the real point of this, now that we've set the context, is to tell you some about, well, what are these rebates doing and how is it different? I already talked about this. The rebates came at the worst economy let's see, that's a design, the second slide. Okay, so in terms of the research design, so our approach to thinking about the responses of households to stimulus, the rebates here in particular, has been to use household surveys. And so these are nationally representative, and to do this, we design a module, a set of questions. The data I'm going to show you today are the questions that we ran on the surveys of consumers. So this is often referred to as the Michigan survey. The data we have right now is for May. We'll get data for June here before too long. We also put a subset of these questions. Some of the ones that I showed you, like the family loss and income was one. We put a subset of the questions on a Google survey that has been run weekly since April, and we'll do through the end of June. So we have two different data sources that we're tracking. I don't have the Google results for today. And the approach in this research design is to just ask households, how will you use the rebate? Right? And I've already showed you some of the questions we asked them about how did the crisis affect you. The difference in this approach is we're not looking at their spending behavior. So a lot of the research that's used the consumer expenditure survey, they're looking at, well, how much did you spend? And did that spending change after you receive the rebates? And there's studies that look at credit card transactions. Did you pay off your credit card balances? And how does that relate to the timing of the rebates? So our approach is different in that we ask households to just tell us, and I'll show you the question in a minute. And we're going to compare, well, actually, okay, so our approach is different. We ask households directly. This last point, there has been research. So on the consumer expenditure survey, they included questions that were very similar to the ones that we use on the Michigan survey. And that allowed Jonathan Parker and Nick Salalis to do a comparison of, well, what do these different methods tell us about the behavioral response? And I mean, happy for us, the two ways of approaching the same question gave similar answers. Like not in every detail, and there are some differences, but for this very basic question of like, did people spend, did they save or pay off debt? Like it really, the spending place looks really similar. So that should give you some confidence as we present this, and it will be some time before the consumer expenditure survey type work comes out. Although there are other papers that have used high frequency spending data that are out already. And it's really good to have different research to compare different survey or different research designs. Okay, so here, just to be clear about what the question we have. So the survey opens with giving them details on the rebates. So like what I shared before about the size, because we don't assume people come into the survey knowing all the like nitty gritty of what's happening in terms of fiscal policy. So the main question, we have a preamble that says, we want to understand how the rebate will change decisions you would have made without the additional money. Okay, so that preamble is important. It's actually something that we added this time in response to feedback we'd gotten on prior research. This is very much trying to make clear to the households, this is about a counterfactual. We're not asking you, what do you do if somebody gives you $1,200 bucks? We're asking, think about how your behavior would have been different if you hadn't gotten the rebate. And so we're asking households to do that internal counterfactual. The thing that is really hard and is what we struggle with identification-wise in any of these studies, because we want to know what would the world have looked like without the rebates and compare it to the world with it. And it's that delta that tells us, what did the rebates do? Okay, so we have people frame this up. And then the main question, this has been used over and over again in this type of research, thinking about your family's financial situation this year, will the rebate lead you to mostly increase spending, mostly to increase saving, or mostly to pay off debt? Okay, so we have these three categories. One thing to point out is an economist would think, well, there's like an extra category here. paying off debt in our models and the way we think about, well, typically in our models, we would think about paying off debt as saving. Like that's related to how you're changing your savings. So it's really just like you have income, you either consume it or you spend it. I'm sorry, you should just spend. You have income and you either spend it or you save it. So those are the two pieces. When these questions were designed originally, and Matthew can talk more about this before, I think it was Tom Juster. So it was one of the very like expert economist survey design people at Michigan said, yeah, you need this other category. Like people really think differently about debt than they do spending or saving. And we definitely see this in the responses, and it's clear that, shockingly, not everyone thinks about the world the way economists do. But this was important for us to like be responsive to how people think about it so we get accurate responses. And then it's our work to sort out what this means, like in terms of economic models. Okay, so what this shows you is just summary statistics on this first question. And what I've shown you, the top panel is showing you the results from May of 2020. So this is the most recent, the recovery rebates. And the bottom panel is showing us May and June of 2008. So this is like the survey, the comparable survey that was run as the rebates were being distributed in 2008 and comparing it to as they're being distributed now. And what you see, well, first off, for our like thinking about supporting aggregate demand, it's the spending response that's probably of greatest interest. And they're very similar, right? So you basically, and these would not be statistically different, but we're seeing, about a little over 15%, somewhere between 15 and getting close to 20% of households tell us they'd mostly spend the rebate. Now, that doesn't mean that the other 80% don't spend, is, they could spend a fraction of it. So that could also go towards the spending out of the aggregate spending out of the rebates. And like I said before, we've also seen people, and we see it in our survey too, because we ask them, well, what did you spend it on? Where they're clearly spending it on things where the rebate probably isn't enough to pay for it all. So you might have a higher than one marginal propensity to consume. Okay, but the exciting difference this time is those who increased saving, it was markedly more than in 2008. And this pattern, I'm showing you 2008, but if you compare to 2001, you compare to or any of the stimulus programs, the rest of the stimulus programs in the Great Recession, like this is the first time saving has become basically it's pretty close to pay off debt, but it always had been the case that pay off debt was the biggest response. And this time saving is really a lot of families. Now, and we have a lot more to unpack with this because there are measures in the Michigan survey about the uncertainty households see, the risk to the economy, the risk to their finances. And so a very intuitive explanation for this is we have more precautionary savings, which would also make sense. I mean, when you have such massive job losses, and there are people that have lost jobs in the last, since March, that probably never imagined they would ever lose a job. So it could make a lot of sense to set this aside and just, we don't really know what the next few months look like, or maybe years. Okay, so that's the basic responses. Now, I do want to go back. We talked about some of the economic insecurity and how it differs. So let's look, I'm talking too much. Let's look at I'm going to look at the families that have had a loss of a job, and then the families depending on whether they have the benefits. Okay, so what stands out here, for families who've lost a job, we actually get a pattern that looks a lot more like past data. And so you have way more paying off of debt, which I'm not going to show you what goes into paying off of debt, but there's definitely like a bleeding between what we would think of, economists would think of as spending, and what people think of as paying off debt. There's some sorry, paying off of, you're paying mortgages or rent or utilities, which are really flow consumption that you have committed to, right? So there's, and what we've seen right now, I may have to take a break and let Matthew talk. What we've seen right now is that there are a lot of programs for mortgage and rent forbearance, in the sense that like you're not going to get kicked out if you don't pay. We haven't seen anything that is a forgiveness of those obligations to pay. So eventually those will come due, but you know, it's using your rebate to make some of those payments probably makes sense, because you'll have to pay them eventually. Okay, let's see, so that's the loss of a job. And then if we think about who has gotten the weekly jobless benefits and who hasn't, this one, there's actually, I mean, the pattern is relatively similar. There's a little bit less of the spending, both in this category overall, but it does appear, and again, these are just, when I show you this slide, it's only people who have had someone in their family lose a job, right? So these patterns look different from without a job loss, because again, here we're seeing this big paying off of debt. Okay, with all of this, like obviously we have, so the survey is fairly rich in terms of the demographics, the expectations, the actual family income. So we have a lot to, and have in the past tried to break this down and understand exactly who is in each of these categories, but it's pretty exciting this time because we've really got to unpack what's going on with the savings and figure out how this is, the responses to the rebates are very clearly interacting with what's happening to the families in the crisis, like in terms of their economic situation. And we have seen this in the past, but this is like it's really clear even from the summary statistics that this is this time it's different in terms of how families are being hit, like how widespread the distress is, and then like the rebates, maybe not surprisingly, are interacting with it. And and it may also have to do with the way the rebates came out really quickly. They came out more quickly than the jobless benefits. So there are really important interactions that we have to think about in the structure. Okay, so I've got about 20 minutes left. Then we'll get to questions and answers. Now I want to take a little bit of time, and this is the piece that draws more on some of the research / policy work that I've done, but it very much jumps off and uses the research Matthew and Joel and I have done, and the research that like everyone has done in this space, and is thinking about, okay, well, how do these direct payments, how do they fit into the response of Congress to fight a recession, fight this recession or anyone? You can already see that Congress passed these part of the CARES Act, but this was a discretionary. Congress had to get together, they had to decide exactly how these were going to be structured and administered. Not even like 2 weeks before the CARES Act passed, the president wanted a payroll tax cut, which is like the absolute worst way to distribute money to households, and we know that from research. But it morphed from that into a rebate that frankly is like my dream structure of how to do this, and is really good. Dream structure, except for one piece, is these should have been set up to happen automatically. Like as soon as we saw the unemployment rate rising in this recession or any recession, just send this money out, right? Because the rebates are something that Congress has used multiple times in the past. And frankly, they had other things they need to be doing in this crisis. Every recession has a different cause. This one is a public health crisis. The last one was a housing price bubble. The one before that was a tech disruption in the tech sector. So every time Congress needs to be focused on, well, what do we do about this latest thing? Every recession, once it gets going, has a very similar dynamic of a collapse in aggregate demand. It'll differ on how big that collapse is. Rebates are a good way to not plug the hole, but at least help. And so the fact that Congress had to spend time on it is really unfortunate. And because we know these work and we know how to turn them on, we can just make them automatic. Now, there's an automatic of turning them on, and now Congress still has the opportunity to do an automatic of turning them off. And in this recession, and frankly, I mean, any recession, if Congress stops too soon, the damage from the recession can last a very long time. Okay, so so we know, like I said, we know what works in terms of how to support families, broadly, families in a recession. I worked with several other scholars on Recession Ready. So this was a volume that the Hamilton Project and the Washington Center for Equitable Growth put out last May. Both of these organizations are very big on taking academic research, so the kind of great work that all of you do, and translating it into policies that Congress could enact, or in other cases that the Federal Reserve could pursue. And what we see, or what this volume did, is it took all the policies that have been used in past recessions successfully and explained how they could be made automatic so they would happen in any recession. And I had a chapter on direct payments to individuals and then be automatic. And I will say, whether it's automatic or it's discretionary, if like all this that we know from research, all this that we have done in the past, if it does not get into policy, it in that sense doesn't matter. It doesn't mean that we shouldn't do the research, but if Congress doesn't actually act on it and put money behind it, well, then we really haven't fought the recession. Anyways, okay, so I won't get too much into this, but like, what does Congress need to do now? We did this big act. They put out the rebates. This was all good. There were a lot of other programs. We talked about the enhancements of jobless benefits. There was a big program to try and do loans to small businesses. The Federal Reserve just like acted nonstop with all kinds of lending facilities and various efforts, which Congress had to, they put money into backing those loans. Anyways, but what's really important at this point is that they continue the relief. And what's been done in the past is you do it by duration. So that's what the CARES Act, so the enhancements to jobless benefits expire on July 31st. The payroll protection program ends on June 30th. So these all have a time duration. This has been used in the past. In the Great Recession, this was very problematic. Congress eventually just couldn't get it together and pass anymore. And so stimulus and relief stopped when the unemployment rate was still very high. Yeah, and there's a way to just write legislation that says this will continue until the unemployment rate gets back down to 5%. There have been proposals put out like that. I mean, automatic stabilizer is something that many economists can get behind because it puts policy on autopilot and pulls out some of the politics that often swirl around Congress. And in this recession, I think it's really beneficial because we don't know how long, like the recovery could be very rapid as soon as the world opens back up and we get back to life, or the recovery could take a very long time. And so instead of like trying to guess how long you need these policies, you just let the economy and people going back to work tell you when it's time. Now, obviously, you have to pick the threshold. Like there's nothing out of our research going to tell you what's optimal, or not right now. If you all want to write something on that, it'd be great. Okay, so like I said, to have an automatic stabilizer, you have to have a trigger on and a trigger off. This is something that just needs to we just need to know what this is. It shouldn't be Congress decides or the Fed decides. And so I had, for this direct payments to people, the chapter, I developed a way to turn on the payments and say, now is the time to send the rebates. The logic of this is a small jump in the unemployment rate is a really bad sign. That means we are heading in, or we are in the early months of a recession. For an automatic stabilizer, at least the way I approach this, I did not want something to forecast, so I didn't use the yield curve. I didn't want to say, oh, sometime in the next year or so, we're going to be in a recession. This was an indicator to say we are in a recession. And it needed to be very accurate because if we're going to send out hundreds of billions of dollars, it would be nice to actually do it when we're in a recession. And so this was referred to as the Sahm rule, is a 3-month moving average of the unemployment rate whenever that has increased a 0.5 percentage point or more above its low over the prior 12 months. We're in the early months of a recession. That turned out to be accurate in this recession as well. And then, like I said, you need something to turn it off. Again, like a 3-month moving average, this time of the level of the unemployment rate. And you could say getting it back within 3 percentage points of its trigger on. I think it'd be good to anchor it to the trigger on. In this case, the proposals are more like getting it back to 5%, something like that. Okay, so this is the Sahm rule showing you. And again, this is all of the recessions back as far as we have the comparable data to 1948. You can see this thing spikes in recessions, it doesn't spike outside of recessions. And from the 1970s on, it has like been accurate in every single recession. There are no false positives. I think this is it's a good indicator. There could be better ones, but this one works pretty well. Okay, so now this other question, and like I said, it's really important not just to turn on, because a lot of times in a recession, like most people, well, Congress tends to at some point be a Keynesian and a foxhole. And so they're going to send out, they're going to do something at the beginning of a recession. I don't think they should be spending their time on that, but they will do something. It's on the back end of a recession that we've seen a lot. The commitment has varied. And in the last recession, it was very unusually bad. Soon they walked away. So this just shows you that, you know, like I said, within 3 percentage points of the pre-trigger unemployment rate. But if you want to be really aggressive, you could say 1%, like we got to get back to 4.5% unemployment, or you could be much more lax and say, you know, 4.5% is fine. What this shows you is, well, how long would these benefits have been on? Okay. This is not a dynamic simulation. Automatic stabilizers did not exist in the past. This was something that was very important to show congressional staff because they needed to have some sense of like, what kind of money are we talking about? And you can see in the Great Recession, this would have been massive in terms of how long you would have had benefits going or any kind of relief going. But this also shows how damaging it was for Congress to step away because they moved away when it was like way high at the end, the right side of this in terms of how far the unemployment rate was above where it was in 2007. So, and the Great Recession was very much an outlier in terms of how soon Congress stepped away and how little support they gave. So a big benefit of automatic stabilizers, putting in legislation that the unemployment rate determines when you turn off relief is you don't take the risk that politics steps in and does what happened in the Great Recession, which, I mean, there's always a risk of that. And it feels like today the risk might be more, and especially we're in an election year and waiting until next year to do another round of stimulus or do another round of relief will likely be way too late. I mean, so there's no reason to mess around with this. And for those of you who followed some of the economic policy debates, there's already some fatigue about like the deficit spending, fears about inflation. Basically every zombie macro model comes out of the woodwork and actually already has. So like we're really early in this to have all this happen. But you know, these things, this is really high unemployment rate. These kind of relief programs will be very expensive. Groups that are relatively conservative, little c in their forecasting, like the Congressional Budget Office, show 10% unemployment, you know, through next year. So obviously that's expensive for jobless benefits and a lot of other programs. Anyways, okay, so that was a little bit about automatic stabilizers. Yeah, this is actually a lot of this is part of my Hill staff pitches. But the Congress and the Federal Reserve, they just have to stay the course and get people back up on their feet. The Federal Reserve has made some, I think, very credible statements about this. Jay Powell yesterday in the press conference said that the Fed is not even thinking about raising inflation, right? So he's like totally meta. We're like nowhere near being worried about this. But that is not, it's not clear that Congress is not thinking about the deficit. That's already had some focus. Okay, so, and the reason that, like, I mean, recessions are really bad on in a lot of ways. We see a lot, like the unemployment rate, people losing their jobs is a big part of what makes a recession horrible. We are seeing, and in all likelihood, we'll see a lot more in terms of business failures, especially among small businesses, and there'll be some sectors of the economy, particularly in services, that are just going to get hit really, really hard. In state and local governments and municipalities. So there's a whole range of things that happen in a recession that are very bad, and that's why we push back on recessions. But there is a lot of research that shows us that the damage from a depression will last a very long time, and especially when the depression is severe. I'm sorry, when the recession is severe. Yeah, see, I'm already in depression forecast. In any case, it can last a very long time, and groups such as people who come out on the labor market during a recession, I mean, there's really great research that shows, I mean, their entire career can be knocked off path on average. Okay, so like we gotta keep at this, and you know, in my opinion, more relief needs to go out. I think the discussion is now that there will probably be some extensions to the relief that's happening. So before the end of July, unfortunately, because it's not a done deal right now, it creates a lot of uncertainty, and there are some places like state and local governments that really needed the money back in March, and won't know if they're going to get it and won't know how much. And yeah, and the Fed's lending facilities to municipalities and small businesses have not really gotten off the ground yet. So anyway, but the thing is we know, and we know because of the work that you all and many people in economics have done, like we know what works, like we know what we need to do to fight a recession. We know where recessions are bad. It's just a matter of translating that research into policies. And actually, since I have a few minutes, I think that was my last slide. One thing that we talked about all the way at the beginning, actually, I'm going to go back, sorry, it's a little, because I didn't end up getting it into the slides. Okay, so this last point, and this is talking about like the translation of research into policy, which is really an art more than it is a science, but you want to base it on science. You want to base it on evidence. So one of the things that shows up in past research and some of the, yes, I'm totally blanking. There's some new research that's been coming out on the 2020 rebates in addition to the work we're doing. And a result that has just shown up time and time again is, again, this idea that low liquidity, so people that don't have a lot of easily accessible funds, they spend more out of the rebate, and they do it really fast. Like they get it and they spend it within weeks. Okay, so the thing is then you would say, okay, we want to stabilize the economy in a recession, which means we want to pump in as much extra demand. So we want to get, one would think, let's get the rebates, let's get the money to people who we know will spend it. And what we've seen consistently in the research is if you don't have a lot of money, like a lot of accessible money, you spend it. Okay, so this has not, like in the policy chapter that I wrote, I am very much on just give everybody money. Like, and I want, like in an automatic program, you just have it set up so you're ready to just push money to everyone. I don't feel strongly about these phase out at the highest income. Frankly, millionaires don't need $3,500. But I feel very firmly that there's not a good way to target the rebates. And even though we know from research that low liquidity would be a good target, the US government does not have statistics on, like in real time, or frankly in any kind of time, on the balance sheets of individual households. Now, if someday we had a wealth tax and we needed to have that information to administer a program, that might be a different world. But the world we live in, like we have no way to do that targeting. And I think some of the proxies, like we talked about the correlation of low liquidity with low income, they're really imperfect proxies. And in particular, in this recession, and you see we have a very high income phase out for these rebates. And yet some of the families who have lost jobs and lost a paycheck, they were up before the crisis in this higher middle class income and then above. Like they were in that income bracket and now they aren't because their pay decreased. So if you got real fancy about like, having different step ups in terms of like the lowest income got the most and the middle income, then in a recession, like that targeting will for some families fall apart. And in this particular recession with so much job loss and so much income loss, like you really it would have been problematic, and the best efforts to get the money to the people that would spend it most would not be effective, or at least I think there's a high chance they wouldn't have been effective. So I think that's something to push folks who are doing research. I mean, that includes us. They're doing research in this area to think about, okay, well, if you like, in a perfect world, you would want to structure the rebates in a certain world or a certain way. Okay, but taking into account that we don't live in that perfect world, what's like the second best? Or a lot of times if you work in economic policy, getting the third best is like great, or just avoiding something that's bad economics is also great. So I think that's where, it can be really exciting when you take research findings and try and figure out how you would apply them in the real world. It doesn't mean like, we can do comparative advantage. It's not like every researcher needs to think about the policy translation, but it is a space where there's a lot of demand. I mean, Congress and the Fed want evidence-based policymaking, but they need evidence to do it. And they need evidence that is at least relatively plug and play into the policy discussions, and a really strong result that they absolutely can apply is a little tough to sell. So anyways, okay, so I will stop there, and hopefully we'll get some questions from you all. So
okay, thank you so much, Claudia. So just to remind everybody, so this opens up the Q&A session. So if you have a question, please raise your hand using the participants button at the bottom of your screen. And to give everybody some time, to set up and think about their questions, I think we'll start with Morten, who had a question. Morten, are you there?
Yeah, no, I just wondered whether it's also a little bit special this time in terms of what can you actually spend the money on in terms of consumption.
Yeah, no, and we have yes, so we ask, and so what I'm showing you are just a really small snippet of the questions in the module we designed. And we do, after people tell us what they did with the rebate, whether it's spending or paying off debt, we ask them, well, what specifically did you buy? And some of it is similar to the past, and some of it's not. So like one thing, and other research has shown this, I mean, we have, of the people who said they mostly spend it, we have about almost a quarter that said they spent it on food, right? And so that's been if all you can do is go, you have to like cook at home and you can't go out. Like, it's not surprising that we have food, and that's more than what we've seen in the past. Now there's other things like, it runs against some of the other big categories are major household items. So in the spending, that's a big piece of it. And we do see the car spending again, which is similar.
I guess one could expect that to sort of maybe go up abruptly once people go out. Maybe people are saving a bit, and then once they go out and look at cars again, and maybe they'll spend.
Martin, we do have two things. One, remember the spending rate is very low. It's only about 15%. Secondly, we ask people who said they save or pay off debt, and we've asked this before, what they're going to do over the course of the year. and about 85% said they would keep their saving or debt repayment high, so that they're not reporting a huge amount of anticipated spending once things open up. Frankly, in the past, when we've done retrospective surveys, some of that slips. So a rate that goes from 15% we found in the past might go to 30%. But people are saying that they're largely going to hang on to the money. So as in the past, a lot of the relief is for balance sheet repair. So people are quite precautionary, and they're presumably better off because the modal thing people paid off was their credit card. So that's going to make them better off having less credit card debt, but it's not going to be particularly macroeconomically stimulative over the next year.
Yeah, I don't know if you know, there's a paper in the AEJ by Søren Petersen and Claus Tustrup on Danish data, where they made the illiquid savings liquid during the financial crisis. And actually, they did a survey as well, and that 60% of the households spend it on consumption. So that sounds very high relative to the US data. That of course may be a function of the social insurance system.
Yeah, and I will say, I mean, some of the research, like the Parker and Salalis, they have really high, like 60% spending out of rebates within like months, right? So and it's hard to map what we're doing to exactly an MPC, but again, like kind of the basic, like the people who tell us they mostly spend are the ones that if you go and look at spending data, like they spent more than others. I guess, and to Matthew's point about like we've done, like for the 2008 tax rebates, we went back, you know, we asked them in the spring or May and June when it came out, we went back to them in like November, December, towards the end of the year because of the financial crisis. I mean, that really changed the makeup of what was happening in the economy. And then we went back one more time in the spring of 2009, so we could compare to making work pay. So, and it's, I mean, hopefully we'll get some more money from Matthew. But this would be one where as whatever happens in the economy over the next few months, like I totally agree with you, you could see people changing their spending plans because it ends up the world doesn't roll out the way they had expected.
Yeah, no, it's interesting. Yeah.
Okay, thank you. So we have a question from the audience. Pratap, you're able to speak. Please unmute yourself. Thanks.
Hello, can you hear me?
Yes.
Yeah, could you please tell us a little bit more about the data sources and the types of data, like it's like monthly type of data or how, the data sources? Will you please tell us a little bit more about that?
Yeah, so the Michigan survey, so it's the surveys of consumers, what its actual name is. So it started right after World War II, and it was designed to be a survey to capture the sentiment and the confidence of US consumers. And so these data, the surveys are now done monthly, and these are the expectations component, like they have a few questions they ask households, like what do you see happening in the economy or in your finances over the next few years? That is part of the leading indicators. So that's like a series, and these are different from different data sources that have been predictive of where the economy is going. So that the only point of that is these data are used in a lot of the Michigan survey data and the expectations and this like longstanding principle of asking households, what do you think? What are you doing? This has shown a lot of usefulness in thinking about the macro economy. So that's just broadly what the survey is. And they run, in addition to the like standard questions that are always in the survey and build these indexes of sentiment and expectations, they also have modules. So researchers can write questions and have survey time. And that's what we have done and have done in the past. So we have a module that is on the 2020 tax rebates, and it's the standalone. I think our survey this time is about 15 questions, give or take. But Matthew, Joel, and I like sit down and write the questions and have some really fun editing meetings to try and figure out exactly how to ask it. And it's this like interplay of we want to ask the questions in a way that we can tie them back to economic theory and the questions and the models we're trying to do. And we also have to ask the questions in a way that people, all kinds of people, like non-economist people, can answer them. And what we found is like these questions we ask are really successful in all of these. You know, we ask people pretty complicated, like we're asking them to do the counterfactual of like, what's the world now versus the world without rebates? What do you spend it on? Like there's all these different questions. And in each of these answers, you have the option of saying, don't know, or this just doesn't apply to me. And in fact, like people really do not have trouble answering these questions. And the don't know rates are really low. So they're hard questions, but people seem to, you know, they answer them. So I don't know, Matthew, do you want anything, add anything about the survey?
No, it's a random digit dial telephone survey, if that was, and it's about 600 respondents per month. If you want those kind of details.
Thank you.
Claudia,
Thank you.
there was a question from Bitsy Perlman that I think is directed to you. I'll just read it to you. Have you given thought to ways to taper off benefits rather than having a simple off trigger?
I saw that question, but can we save it for a little later? Because
sorry. Okay.
Data question. So let's concentrate the data questions. And I also had the related questions to Bitsy.
Okay.
So let's, Ralph, do you want to step in and ask your question also related to data?
Yeah, just quickly on the data that you have. So perhaps you said that, Claudia, and I just missed that. So what is the time period that households going to spend this? Are they asked whether they spent that within a year, within half a year, within a month? And then the other question would be about the unemployment benefits. Have you also asked them whether they would spend the unemployment benefits? And for those people who lost the job, have you asked them what they expect when they get the job back, whether that's like a very temporary job loss or more permanent one?
Yeah, Susie, you need to write a survey. No. So on the first one about the timing of spending, yes, so we do ask that. And so what we find, I'm pulling this up, so about a little less than a third of people tell us that they will spend it within a few weeks of getting it. Right, and we do have a little bit of difference. Like we ask people in the beginning, have you got the rebate? And if you say, no, I haven't gotten it, it's like, do you expect to get the rebate? And those numbers should be coming up. By the end of May, people really should have gotten their rebate. So anyways, but so some of this, when they tell us, oh, we're gonna spend it within a few weeks, they may not actually have spent it in May yet because they haven't gotten it. But that's a big chunk. And then the modal response is spending it within 1 to 3 months. So this again goes back to, and this is very consistent with the research done on the consumer expenditure survey. Like when people spend it, like they spend it. Like not everybody spends, and it's not the most common response, or in our survey, but it's fast. And then actually the last group that really counts, I mean, it's, more than 3 months, right? So, but that's the smallest of our kind of 3 response options. And that's another reason this is a very effective policy in a recession. Because if they don't, like you want to get in early in a recession to stop the spiral. But so you asked one more thing before I go to your other question. So I'll tell you data we have before I have to tell you what we don't have. The other thing that when we were asking, like before we got into very specifically, what did you spend this on? We were trying to figure out like, are you spending it on things you normally buy? Like, is it just, maybe your income went down and so like, you have to pay your mortgage and your utility bills. So it's really just letting you like keep doing what you've been doing. Which is important in a recession too. Like a recession, you see this big drop in spending. Like I wouldn't expect people in the COVID-19 to just go out on a shopping spree, but you do want to help stabilize spending. So we saw that about half of people told us that's what was happening. Like if they were spending it, it was just to spend on things they'd always had. It was only about 20% of people that told us they were spending it on things that they had to buy because of the crisis. So, and, you know, it's a public health crisis. Like, there are things that have happened in this crisis that could change what you need to spend. And then there's like this something else category, which makes up the rest. And then we went into like specifically. So we do try to unpack, and we have all of these parallel questions on the debt side, because again, there's overlap in what people think of as debt and spending. And I think Joel had found, there was an Australian survey. There was another survey that was kind of in the spirit, but it only had spending and saving. And what happened is the spending went up a lot. So it feels like that's where people want to be. Now, on your other questions, like asking about other questions. So the thing of the purpose of the module had been to focus on the rebates and what do people do with them. It was clear when we were writing these questions that this recession had some very unique attributes to it, especially how fast everything collapsed and how widespread. So we didn't, while we have these questions of, has your family lost income? Has someone lost a job? If they lost a job, do they have benefits? We do have a question, has someone in your family gotten sick from the virus? But we didn't like ask, do you expect to get the benefit? Because really this like not having received, I mean, it makes sense in some ways given the administrative breakdowns of unemployment insurance, but that we wouldn't have thought to do that. But because we do have a lot of other expectation data in the survey, and in fact, one important one is there's an income expectations question. So there may be some ways to use this data to answer very different kinds of questions that are somewhat, they're related, but not like tightly related to what did you do with the rebates.
Okay, thank you so much, Claudia. So we're going to do one more data question, actually, Laura, and a data question, and then we can go to the broader, more conceptual questions. Laura, are you there?
I'll make it quick because my dog is like riding. So I was wondering if you knew, like I saw this document on the rebates that were sent out that said that the checks that were mailed, so for people who didn't get the direct deposit, the checks that were mailed out in a particular order. So they were first sent to people with very, like it was sent out by income actually, as opposed to other times where it was done randomly. So I was just wondering if you know, I mean, I guess the direct deposit, maybe that all happened within a couple of weeks, so it's not so relevant, but if you knew how they decided to do that and yeah, where you can find that information.
Yeah, so so you're right. This time the paper checks went out by income. So they prioritized low income, which was different. The reason the 2001 and 2008 research design with the consumer expenditure survey existed was because all of the rebates, I mean, this was most important for the paper checks. Actually, no, for the paper checks in the past two recessions, they were randomized. Well, they were based on the last two digits of your social security number, which is random. And so that was what gave the identification, because the timing of the rebates didn't depend on anything. And so you could compare people in a cleaner way than just like, oh, they got a rebate, they didn't, because there's all kinds of selection issues, or like the recession gets worse over time. So like late recipients versus early would be a problematic comparison. But prior, it was like the randomization. This time it was by income. So you're not gonna do that, like that, you don't have that identification. And yet like over time, fewer and fewer people have gotten paper checks. And the expanded eligibility this time, so you have Social Security beneficiaries, basically anyone who has a federal government benefit. So like veterans, government retirees, anyone, so they all have direct deposit. Like, so they just, I mean, because those programs are administered that way. A huge fraction of people who file taxes, including like earned income tax credit families, I mean, almost all of them are on direct deposit.
I thought even the direct deposits didn't all go out like at once. It was staggered over like.
No, the direct deposits, basically the, yeah, and I will say just as a data point, in our survey of the ones who'd gotten their rebates, over 90% had gotten them by direct deposit. Now, and again, like we had this kind of like rolling in May. So the mailed, it was only 6% got them by mail. That should come up, but it shouldn't come up that much because there really aren't that many people, like it's maybe about 15% of recipients should get them by check, I think, and that would be a high end. But the direct deposits, what happened is the big time constraint is creating a file of like, who are all the people that get this and what are their bank account information. And the federal government, for better or worse, doesn't just have that sitting around in a database. So they have to like pull it from IRS and Social Security. So, but once that database is created, it's just like a stroke of a key, right? Because there are no constraints on how much money can go electronically out of Treasury. They can only print so many paper checks, and that's what the delay is. But what was kind of nifty this time, because they did basically anyone who has a Social Security number can get a rebate. Not everyone with a Social Security number files taxes or is a beneficiary from these other programs. And so they created a website where you could go on and like type in your Social Security number and your direct deposit information and just get a rebate. So, but all that takes time, right? So like those weren't the first people to get it, and you had to know to go apply, but I don't know. So yeah, the delivery is a little different, but I think the thing I would stress the most about the delivery is these went out so fast. Like in 2008, the rebates were passed at the end of January, and they didn't go out until May or June, right? So the fact that like the CARES Act passed towards the end of March and the first checks went out the middle of April was just like amazing.
Okay, thank you. So we have a question from the audience that went away. So if you're in the audience and you have a question, please raise your hands. But since the question went away, I actually have a question that may be a little bit unfair because I think it's sort of outside to some degree your data, but I wanted to get your take on it. So in many European countries, rather than have stimulus checks or expanding unemployment benefits, the system that was put in place was to just pay firms to continue paying wages to workers who were no longer working temporarily. And to some degree, we also had that ability in the United States with the payroll protection program, which has not worked very well, partly because of confusing, I think, guidelines in terms of which small businesses were eligible or not. But how do you view the complementarity? And in principle, some businesses, could have not laid off their workers and continued paying them a wage, as opposed to the workers filing for unemployment benefits. I don't know if there are any questions in your survey that try to figure out if any of the respondents benefited from the payroll protection program. But what is your sense based on both the literature and your findings with respect to the impact of the payments and whether directly to household on the complementarity of these two programs? Or the efficacy of one or the other. So what can we learn about this from the survey that you run?
Yeah, so I guess the quick answer, and Matthew might disagree after I finish talking, but I think within our survey and these results, we would have a very limited capacity to say anything about the interaction or the trade-offs of the enhanced unemployment insurance benefits, which the US has used typically, and the payroll protection loan program. Now, I will say that Kurt, who's sitting here, Mittman, ought to be working on this, because I mean, anyone who like really studies the unemployment insurance system, like that's really where the trade-off is, or the comparison is, and not the rebates. I think the rebates can complement either of those two approaches, and the rebates don't have this disincentive effect. I mean, and they're not big enough to be like a moral hazard, like you're going to be waiting for $3,000. But that's one where it's a very broad-based support. I think this time, one of the things that happened that's probably more relevant for the enhanced benefits, and we do see this, is like the rebates got out really fast. So they could have very well been a bridge until you got like the unemployment benefits that you claimed and you were coming, they just hadn't processed. Now, I will say in terms of like stepping back, and I talked about automatic stabilizers, this is yet another reason that Congress should sit down ahead of a recession and figure out what's the best thing to do. I think there's a lot of research, and I mean, the experience in Europe has a lot to suggest that supporting employers so they keep workers on payroll, that you never break or you you try to minimize the breakage between employers and employees, like by keeping them at work and having the government subsidize it. I think there's a lot of evidence in Europe that that has worked very successfully. It's not a given that that would translate to the United States, even if they, in the same way, like, because I think unions in Europe do a lot to help like make that work well. But doing a policy like that, and there have been other proposals floating around like wage replacement stuff, like it is extremely hard to do good policy on the fly. And like in the middle of a crisis, designing it from scratch, like trying to run around and grab all the benefit, like all the pieces. And the payroll protection program is an excellent example of what a very well-intended, based on experience in other countries to some extent, that is so important to keep worker. But I mean, it was just a colossal failure of a rollout. Now, it wasn't a total failure. And there are, for like, one of the big lessons, and to me, the last jobs report was a surprise. It was not my forecast, wasn't the forecast. A lot of other people have been watching claims, but like it showed to me like relief is working, right? And it's not like for people to be coming back to work and coming off of furlough, that means that not just the economy is reopening, but there's still a business for them to go back to. And so I think the payroll protection program almost certainly has to be a part of what's there. I mean, that does expire soon. Like we got all kinds of identification here in terms of event study, turning on and turning off. But that could very well be an outcome of this, is if we show that even though it wasn't administered well, it really, like the payroll protection loans were really good and helpful, then that could be a time, well, okay, let's sit down before the next recession and think about how it should be done. But we really don't have anything, unless I'm not being creative, and Matthew, I just don't think we have anything in the scope of our survey, but I do think there's scope within the broader discussion of automatic stabilizers, which has gotten a lot more, or just like fighting a recession. I mean, there'll be plenty of research on payroll protection program loans, but I think you're totally right to have it set up as a comparison to the efficacy of the unemployment insurance system in the US. So.
Okay, well, thanks. So we have a couple of questions from the audience. So Johanna, you're able to speak. Please unmute yourself. Thanks.
Can you hear me?
Yes.
Oh, hi, Claudia. That was a very interesting presentation. And I was wondering if there's any information in the descriptive statistics on the geographics. So how people have maybe different spending behaviors in different areas in the US?
Yeah, so we have, we get from Michigan, and I haven't analyzed this yet, but you're totally on point that geographic differences, both in terms of spending, but also just like setting in the context of where the hotspots were of the pandemic or the shutdown, you know, like that could be important. What we get from Michigan, and as Matthew said before, it's a random digit dial survey. So it's a phone survey. They do a little bit, I think they have some internet stuff that they're trying out. In any case, like it's mainly phone numbers. So what we get from them are the area codes. Now for this survey and any survey, geographic information is much more sensitive. So like we have to be very careful with it. And what those map one-to-one to states. So we can very easily do like state level analysis. And in our paper that looked at rebates versus making work pay, we merged on local unemployment conditions to see if like that added anything relative to like the job situation that the respondents told us, like they're kind of their own subjective valuations. And we didn't find anything there, but I think there are reasons, like the geographic didn't add anything to what we knew from the households. I do think there's a potential in this crisis that it could be different, or we could find something related to the pandemic and the hotspots that might help us understand the spending. I will say, I mean, we have 600 respondents in a month, so we'll have a little over 1,200. That's not, you can't push really hard on geography. Like we're not going down to zip code level analysis, right? So, but yeah, no, that's definitely a place to, and within the scope of what we have in the data set.
Okay, cool. Thanks.
Mm-hmm.
Okay, thank you. And next we have Sahid. Sahid, you can speak. You can unmute yourself. Zahid?
You have to unmute.
I did, sorry.
Oh, he looks muted.
Let me just see. No, I am unmuting, but it's not working. Here, there you go. Sorry, Zahid, you are unmuted now. Nope, still, sorry, I'm not able to unmute him. Maybe some of the co-hosts can try and unmute him because it's just not working for me. Can somebody step in?
I tried, I can't do it either.
Yeah,
do it either.
sorry, Zahid, we are not able to unmute you.
Well, if you, Zahid, if you put it in the Q&A, I can
Yes,
just, we can
we'll ask
read it
question
and.
for you. Yes, let's do that, Zahid. There's some technical issue. So in the meantime, though, I want to go back to Bitsy's question that Matt was referring to and just the whole automatic stabilizer idea. So I really like the idea of having a rule by which, you know, if you, once the recession starts based on an agreed upon principle, we step in with a program and there's no political bickering and so on. There are a couple of issues though, but if I'm a person who, you know, understands that I'm somehow insured from, you know, unemployment risk or loss of income risk coming from a recession because there's this optimal stabilizing scheme, you know, that may reduce my saving or may lead me to take on more debt that then makes me more vulnerable to idiosyncratic risk that is not insured. And you know, obviously, if I'm fully rational, I understand that my idiosyncratic risk may not be insured, but, you know, it's kind of hard to distinguish, you know, idiosyncratic from aggregate risk. So that's the first part. And the second part related to Bitsy's question is, how do we then end, you know, the scheme when the recession ends? And, you know, because in general, particularly since the 91 cycle, we've had really conflicting signals, particularly from the labor market, about when the recession ends. So we've had, you know, these jobless recoveries in which output picks up, but then, you know, unemployment rate stays high or unemployment rate falls, but the employment to population rate is still low. So how do we deal with this? You know, the possible disincentive from self-insurance from idiosyncratic risk and then figuring out, you know, what we do at the end.
Yeah, so two things. So one, the issue about the self-insurance and how policies may discourage households from not having their own private buffer, you know, so that you just rely on the government for different programs. So I think that question goes well beyond policies to fight a recession. I mean, one of the things, and I kind of mentioned this before, in a recession, financial security of families, a large number of families gets much worse, right, in a recession. But frankly, like for decades and decades, there are a non-trivial fraction of households that have very little in liquid assets. So, I mean, just one like mind-blowing example from the Survey of Consumer Finances, they went and looked at like how many households have $400 in liquid assets. This was a little bit like riffing off a survey that's more subjective at the Fed. And even in 2016, which is well into the recovery, a quarter of households did not have $400 in liquid assets. Right, so like that's not just a huge problem in a recession. I mean, that's like your car breaks down, like just going to work, right? So there's a real issue in the United States of why is it that people don't have like why they can't self-it or why they are not self-insuring. That may be because of programs that discourage them. It could be because wages are very low. Like there could be a lot of things that are making it either very difficult for households to save or making it like not worth their while to save. So I think it's a much bigger conversation. I think one thing, you know, in the, you know, in our data, what we're seeing, like the big response was if you spend, you're spending it to spend on things you would have normally done. So that's a little less of a, like you're spending more stuff, like you had the opportunity to save and you're choosing not to, you're just trying to like smooth out the consumption. So I'm not sure that in the recession is the time to worry as much about that, but definitely like bigger picture in the United States. And it's really puzzling because we don't have the social safety nets that like Europe does, right? So, I mean, there's much more of a public insurance setup. So it's a little puzzling. You'd think in the United States, there'd be more self-insurance, people would save more, but that's not what they do. That's not what the data looks like. In terms of Bitsy's question, yeah, so the tapering, well, okay, first, I still think that like for all of its flaws, the unemployment rate is the best signal that we have of a recession. Like if you only get to pick one, like in legislative text, you cannot put a regime switching factor model. You can't put like an index of like 6 different labor market. I mean, the Fed tried to create this labor market conditions index in the last recession to deal with like the unemployment rate, the population, and Like you can't do that. Like it's just too messy in legislation. So if you had to pick one statistic that has like cyclical properties, it's the unemployment rate. The employment to population ratio has some secular movements, but it has these huge secular trends, right? So it just doesn't move in the same way. So I wouldn't use it as an anchor. But I also, like, not all policies in a recession should be on autopilot, right? This is kind of like putting the bumpers up in terms of like something automatically happens on the front end and the back end, and Congress can always do more. And they could always vote to shut it off, right? Like, you know, nothing is engraved in stone. The tapering, and this actually comes up with the $600 benefit, like the Joint Economic Committee proposal that's like a Senate House proposal that I've helped work on. Like once the pandemic, like there's this thing called the Stafford Act, which is basically the national stay-at-home orders. Once that's lifted, like what they propose is going from 600 to 300. And then as the unemployment rate falls, and I think it's like an 8% or something of that cutoff, then it goes to 200. And then once the unemployment rate is down to like 5.5, it just shuts off. Now you could have different discussions about what those exact points should be, but this tapering, and like in the proposal, which I think makes a lot of sense and wouldn't entirely deal with the work disincentives, because just unemployment insurance durations and stuff, like it has its own, that creates its own conversation, but you can taper. And then like in the proposal, I had to do direct payments. Like in my recession ready chapter, it was like you do the direct, if it's a severe recession, which this one would count as one, you would do the payments every year until the unemployment rate came down. But as the unemployment rates coming down, they scale down. Mm-hmm. So they're smaller and smaller. So there's other like, so I think this idea of you would taper, but how you would taper, if it's automatic, you've got to taper it tied to something. And I still think, although I'm open to other ideas, but like, I think the unemployment rate ends up being a good way to taper, so.
Okay, well, thank you. If there are no more questions, I think we can close the discussion, because also we are out of time. So that's a good reason to do so. So thanks so much, Claudia and Matt, for a great presentation. And let me remind everyone that we're back on next Tuesday at 12 p.m. Eastern, and Bob Hall will be presenting. So we hope to see you then. Thanks again, Claudia.
Thank you, Stefania. And thanks everybody who joined. Appreciate it.